I'm going to need to ask Larry how he attracts such talented PhD students. We've got another one to hear from just now, which is Victor Roy, whose teaching, I know from experience, is excellent, and you'll be able to enjoy his presentation. He's a PhD student in sociology here at Cambridge, but he's also getting his medical training at Northwestern University in the US, so dual threat there. He's interested in the political economy of how health systems respond to epidemics. And today he's going to share a snapshot of his doctoral dissertation tracing one particular epidemic and its pharmaceutical dimension. Thank you, Victor.
Good morning, thank you. So this morning I'm going to tell a story about how a cure was developed for a global epidemic, hepatitis C, and the dynamic of financialization and how it impacts both the drug development process and our public health. And when I say financialization for the purposes of a 6-minute talk, I'll say two things. One is to note the short-termism in the stock market and the financial sector. And the other dynamic associated with that is how companies use financial maneuvers to meet those short-term demands. And that's something that'll be coming out in the course of my talk. So the case study. Hepatitis C, the case study of hepatitis C is the way into this, and so it's a global challenge. Many would say it's not showing up there. Up there it is. Is a global epidemic in terms of from advanced developed countries to places like India and sub-Saharan Africa. And it's a silent epidemic in the sense that the virus affects the liver through the scarring of liver tissue over a course of many years. But a significant percentage of these patients will progress to having end-stage liver disease and potentially require liver transplants. The main takeaways here, though, is the disease is spread through the blood through injecting drug use. An earlier group of patients got it through blood transfusions. Many of the patients are in vulnerable groups, incarcerated populations, and the disease, of course, has serious implications for these patients. And for them, before December of 2013, the treatments available weren't all that great. There were massive side effects. It was like taking cancer medications, and the cure rates weren't all that high. And in December of 2013, sofosbuvir is the main compound in these new treatments were launched and approved by a company called Gilead, showing cure rates of between 90 and 100% after taking the medicine for 3 months. The virus was out of the bloodstream. Now, in addition to it being a medical marvel, the story of this cure grabbed a lot of headlines because of its price tag. So it got dubbed the $1,000 a day pill. You take this medicine for 3 months, costs about $90,000 for regimen. It immediately led to a lot of consternation. Treatment activists, a US Senate investigation, health systems started restricting access to the treatment. Now, the main argument that often we hear about in terms of the price of new medicines is that drug development is really costly, it's really risky. These figures, however, are also a source of dispute and contention. What we wanted to do, working with my supervisor, Dr. Lawrence King, we tried to actually look at the entire drug development process. So this is a really abbreviated story here. So early on, and the PowerPoint here is giving you part of the punchline at the end here. But early on, there's a company that was spun out of publicly funded research at Emory in the US called Pharmasset. They were able to also raise money from private sources, venture capital, and ultimately an IPO on the stock market, an initial public offering. And during this time, they spent about $62 million on developing this compound from preclinical to phase 2. Now, Gilead, at this point, seeing that they could have a potential huge market here with Hep C, acquired the compound for $11 billion. So you see the discrepancy here in terms of the development there and how much it costs to acquire the compound. They completed the late-stage trials, and it was approved after that in December of 2013. So what emerges is really a picture in which a lot of early risk-taking is done through the state, through early venture capital, through startups that emerge from this science, and large companies here, in this case Gilead, actually acquiring the startup. And this is actually what they state very openly publicly. The founder of Pharmasset talking about, I coined that name, it's actually pharmaceutical assets, and the idea was to create assets that would be sold to companies. And Gilead talking about their business model, we typically like things where we can have an impact on phase 3. They need to generate short-term growth. The best way to generate that short-term growth is acquiring compounds where the risk-taking has already been done through earlier public and venture capital funds. Now, the price, where does it come from? So this is just a comparison here. This is actually right from their strategy documents in terms of how they came up with the price. They looked at the price of prior drugs in this area, and they basically said, well, we can price just a little bit above. They considered prices from 50 to 115,000, and ultimately settled on a price of around 90,000, based on the fact that they thought that their drugs offered a better cure rate. The challenge here is that the previous drugs only treated very sick patients, and with a curative therapy, they were gaining access to the entire potential patient population for Hep C, which led a lot of health systems to restrict access to the sickest patients from the NHS across Europe and the US as well. And we know that this kind of rationing means that the epidemic will be with us much longer. So this is just some mathematical modeling that I've done with Stephen Kistler, who's here, and just showing how by rationing the treatment, treating only advanced, the epidemic is around for quite a bit longer, as opposed to potentially if we were to scale up treatment, you could see a rare disease in the next decade. Gilead, in the meantime, has done really well. They've made $40 billion on this drug, one of the most profitable launches in history. Most of this profit, though, hasn't actually been gone back into research. Much of it is being stockpiled for future acquisition, and a lot of it is also going back into share buybacks. So what are share buybacks? They're actually a strategy that companies use to buy back their own stocks to increase the value of the remaining ones on the market. They're a way of trying to maximize shareholder value. And some of these findings we actually published in the BMJ. I encourage you to read the article. Gilead actually fired back, so it's an exchange worth reading. The interesting final point that I want to close on here is that the financial sector, though, has modeled out actually the public health epidemic here. They show that the epidemic, because it's a cure, the market potential is actually decreasing, right? So even though the revenue might be $10 billion in 2025, and though the company's revenues have tripled in 3 years, the stock market over the past year has actually sunk their share prices by a third, because they don't see Hep C anymore as a growth opportunity. So it sort of shows how the short-termism in the market forces companies, in this case, Paul Carter is saying that their company gets asked about whether they're going to make another acquisition every 5 seconds from Wall Street, even though they've just come to market with this therapy. So it's a case study in how the financial sector really does ultimately also influence our public health. Thank you.
Woody Kahn, I was a founder member of the John Morden Trust for Drug Users with Hepatitis. I think a factor on both sides of the Atlantic, and you particularly mentioned the prison environment, which is often where European patients are identified, is that these are seen as undesirable patients by most health systems. And you mentioned Texas, and they've had a deeply punitive approach to both felons and drug users for decades. How does that political factor influence your economic measures?
So I think that in this case, because it's, as you say, it's a great question, because it's a marginalized population, stigmatized, it sort of created a perfect sort of battlefield for health systems to also debate and argue and sort of with the pharmaceutical industry over access issues here and trying to gain some price reductions here. But ultimately, I think if this were a situation like cancer patients, or you're seeing with the EpiPen situation with the price increases, in that case, parents really revolted and you're seeing companies having to respond. In this case, we're not seeing the same kind of political attention or in terms of and price reductions and sort of policy changes that could otherwise come.